All right, today we're diving deep into a really powerful corner of the financial world, merchant banking in India. We're going to find out exactly who these financial architects are, the people who literally build billion-dollar companies from the ground up.
You know, have you ever really stopped to wonder how a company actually goes from being just an idea to launching a massive, multi-billion-dollar IPO? Or how they get the money to build a gigantic new factory? I can tell you, it definitely doesn't happen by magic. It takes a very specific, very high-level kind of expertise.
What they do is bring in a specialist. Think of them as a financial architect, someone who designs the entire blueprint for raising incredible amounts of money and navigating the super complex world of corporate finance. And that architect? Well, that's a merchant banker.
Okay, so what in the world is this financial architect? Let's get right into it and break down what a merchant bank actually is and what they do.
So this is the official definition from India's big market regulator, SEBI. Now that's a lot of legal jargon, right? But it all boils down to one key phrase: issue management. It's the whole complicated dance of helping a company issue securities, stocks and bonds, to the public. They're the managers, the consultants, the advisors. They run the whole show.
And this is super important because it clears up a really common point of confusion. A merchant bank is not your everyday commercial bank. You know, the one where you have a savings account. Those banks take deposits and give out loans. Merchant banks, they don't take deposits at all. They work on a totally different model. They provide highly specialized, fee-based advice to big companies that want to raise money from the capital markets.
Now, this whole concept is definitely not new. Its roots go way, way back. We're talking centuries. So let's do a quick trip through time to see how we got from early European traders to the titans of modern finance we know today.
The whole idea really started with wealthy merchants back in Italy and France. They were using their own money to finance trade expeditions, but it really took off in the UK, where they became absolute masters of financing international trade. Then, over in the United States, this model morphed into what we pretty much all call investment banking now. And for a long time, the Glass-Steagall Act actually made it illegal for investment banks and commercial banks to be the same company, just to keep the risks separate.
So that's the global story. But how did this idea make its way to India? Let's take a look at its journey and how it became the powerhouse it is today on Dalal Street.
In India, the journey really kicks off in 1967. That's when Grindlays Bank first brought these kinds of services to the country. A few years later, ICICI became the first big Indian institution to get in the game. But the real explosion, the absolute game changer, was India's economic liberalization in 1991. That just opened the floodgates, and today you have major players offering the whole suite of investment banking services.
And believe me, the role of these Indian merchant banks has grown like you wouldn't believe. I mean, it started out as just managing IPOs. Now, it includes incredibly sophisticated advice on massive mergers and acquisitions, complex restructurings, the whole shebang. They've become totally essential to corporate strategy.
Okay, so whenever you're dealing with this much money, we're talking billions of dollars, the futures of huge companies, and the savings of millions of regular investors, you absolutely need a strong set of rules. You need a referee. And this is where the regulator steps in to govern these financial architects.
In India, the top cop, the ultimate authority for the entire securities market, and that includes merchant bankers, is the Securities and Exchange Board of India. You've probably heard of them, SEBI. They write the rule book.
You can basically think of SEBI's oversight as resting on three main pillars. Pillar number 1, rules for raising capital, which makes sure that when a company goes public, the process is fair and transparent for everybody. Pillar 2, rules for fair markets. This is the big one, the insider trading laws that keep people from trading on secret information. And Pillar 3, rules for big moves, like the Takeover Code, which governs huge corporate deals and, crucially, protects the little guy, the small shareholders. So what exactly is inside information? Well, the regulations are super clear. It's basically anything that the public doesn't know that could move a stock's price. Things like upcoming financial results, secret merger talks, or maybe a sudden change in the CEO. Merchant bankers are around this kind of information all the time, which is exactly why the rules have to be so incredibly strict.
So at the end of the day, this entire web of complex regulations really serves one main purpose: to build and maintain trust in the market. By making sure things are transparent and fair, SEBI's rules protect the interests of every single investor, from the biggest financial institutions to the smallest person buying a few shares.
All right, so we've looked at what they do, we've looked at how they're regulated, but let's zoom out and ask the really big question. Why does any of this matter for the economy as a whole?
If you're going to remember just one thing from this whole explainer, what should it be?
Here it is.
Merchant bankers are the vital connection between a company's big dreams and the public's money. They are quite literally the engine for corporate growth, for innovation, for creating jobs. And SEBI? SEBI provides the roadmap for that journey, and just as importantly, the guardrails to make sure it's a safe and fair trip for everyone involved.
And that kind of leaves us with one final thought to chew on. As the Indian economy keeps growing and aims for even greater heights, its companies are going to need to raise more money than ever before. So the question is, what more complex challenges will this create for the financial architects who make it all happen?